Tom Lee was just on CNBC and he talked about a lot of things. He talked about the market, but mainly he did something, honestly, I haven't seen him do in a long time, which is talk about an individual stock. Now, Tom Lee is a macro guy. He almost never mentions any individual stocks. In this segment, I'll show you in a second, he actually talked about Nvidia, calling it a generational story. Now, I'm a simple man. Whenever Tom Lee speaks, I listen. Now, I'm not saying that this guy's right 100% of the time. I'm just saying that he's right way more often than he's wrong. And his clout is justified. Now, before we talk about Nvidia, because there's a lot to cover as far as what he said, I do want to talk about what he said as far as the market. Now, Tom Lee holds the opinion that in the next 3 weeks, we're going to see a blast off in the market. June is going to be the month where the market skyrockets up. Now, his theory is based on a few things we've covered here in the channel in the past, such as inflation slowing down, such as lots of money on the sideline, waiting to get back into this market after sitting out for the most part 2023 and half of 2024. And there's a lot of different aspects to this. He may be right, he might be wrong, who knows? But his arguments will be heard on this show and will be explained and analyzed by me, giving you my 2 cents about how credible what he's saying.
I'm wondering if you think in any way that, thinking that June is going to be the point of the year in which we start to get this money off the sidelines and into the market, and how Goldman Sachs framed it the other day, talking about a, quote, wall of money coming in, but not really until July, that you could have some selling between now and then, but that the beginning of the third quarter and thus the second half of the year is the area to really plan for a wall of money coming into this market and then pushing stocks that next leg higher.
Scott, that dynamic is certainly at play for a couple of reasons. One, April was a down month, and I think a lot of institutional investors actually sat out May thinking April was the start of a bigger correction, so June is when money starts coming back in. But I think more importantly, since the end of 2022, I think a lot of institutions and a lot of high net worth individuals sort of sat out this market saying, hey, I'm happy earning 5%. By the middle of this year, if the S&P is up 15%, on top of missing 30% last year, I think a lot of folks are going to say, listen, I can't just sit on cash and earn 5% anymore when I'm missing out potentially on a 25% year for the S&P.
Now, since I don't like to waste your time, here's the bottom line of what Tom Lee said. The main argument of Tom Lee is quite simple. He's saying, look, guys, there's lots and lots of money sitting on the sideline, money that hadn't participated in this euphoric market since the beginning of 2023. Lots of money managers thought it would be a good idea to put their money in a 5% bond market and not get into this 2023, 2024 because the market is going to go sideways, maybe even crash. So they took a bet. That bet did not work out. Obviously, the market did crazy numbers. Tom Lee talks about 30% in 2023 and 15% since mid-2023 to now. So however you spend this, the decision to park your money on the sideline was not a good decision as a money manager. And right now, as a money manager, because you're answering to stockholders or to some very rich people that actually want their money to make more money, you have to provide some answers why you missed out on 30% and 15% if you go just 1 year back. And that's a very difficult question to answer. Now, Tom Lee is talking about $6 trillion that is parked on the sideline. I think that number is a little bit inaccurate. Well, not the number itself. I think there are $6 trillion, but that $6 trillion is not going to go to zero once immediately everybody goes into the market. It's not going to be this avalanche of $6 trillion going straight from the bond market to the stock market. It doesn't work this way. Certain people want to be in bonds. Certain people just want to be in the bond market for whatever reason. So probably we're talking about anywhere from $1 to $2 trillion that are waiting to switch from bonds to stocks. So the delta we're talking about here is about $2 trillion, give or take. That money will flow all the way from bonds to stocks. And even though the number isn't accurate, $2 trillion is enough to be that cash wall Tom Lee is talking about that will push the market upwards. And as we get closer to the end of the year, in fact, we're already past the midway point, the heat is turning up. The people who manage money for some rich folks, they're sitting on the sidelines sweating bullets because they're getting paid to outperform the market. And what they've done for the clients for the past year and a half, 2 years, is give them 5% what the market did 30%. Now, if they don't fix this soon, they might be out of a job. And if you're out of a job in this kind of industry, you're out of a job forever. You're blacklisted. At the end of the day, it's a game of chicken. All this money on sideline is basically saying right now, look, the market is too hot. Eventually, it will have to correct. We're going to wait until the market corrects. On the other hand, they're being pressured by their bosses to get in the game. So they're trying to play a game of chicken against the market. Now, there's one thing I've learned over the course of many, many years of doing this. You'll never play a game of chicken against the market. The market can stay irrational much longer than you can stay solvent, my friend. And that applies to the retail investors, and that applies to the professional money managers. So at the end of the day, Tom Lee is 100% right. June is going to creep up on these people, and they'll understand that in a second we're going to be in July, and in August, and in Q3, and in Q4, and by the end of the year, they will be out of a job, disgrace, and absolutely canceled. That is going to push a lot of money into the stock market, pushing the rally even further. I absolutely agree with Tom Lee here.
We don't want to be in a situation where the economy is slowing so much that we've actually hit stall speed, so rates would go down. That type of economic dynamic would scare stocks. So it's almost like bad news is too much bad news. In fact, maybe that's why today's jobs report kind of fits right in the middle, because it's actually good enough to tell us the economy is still strong, as you said, but it's not enough to actually add to inflationary pressures.
And the second part of his argument is even better. He's saying one simple thing. He's saying, look, right now what we're seeing is that inflation is slowing down while the market, the macro, is actually holding up nicely. Jobs, GDP, it's fine. Now, it's not perfect, but it's good enough. Now, in that situation, we are in a perfect setup. Tom Lee is telling you, hey guys, you shouldn't be cheerleading for higher job loss numbers or slower economy that will force the Fed to cut rates. If you go back in history, you'll find out Tom Lee is right. Whenever the Federal Reserve was pushed by the economy breaking to cut rates as a preventative measure from preventing the economy from collapsing, that never ended up in a bullish cycle for the stock market. What Tom Lee is saying that we need to hope for stronger economic data along with inflationary slowdown. If that happens, we're going to have a proactive Fed reducing rates on their own terms, not being forced to do so by the economy breaking. In this setup, the bull cycle is almost guaranteed. So Tom Lee is saying you stop praying for job numbers to go down, stop praying for the economy to break. That's not going to help you. These sort of rate cuts that you're dreaming of are not helpful. What we need is rate cuts in a good economic environment. This soft landing argument, and so far, has been 100% right.
Tom, what if this market is just screaming out it's Nvidia's world and we're just living in it, right? I mean, if Nvidia's up, markets are good. Nvidia's not doing much. S&P can't do that much. Nasdaq's negative today. It's a one stock story.
Nvidia is really a generational story for now, because how many $3 trillion companies actually have doubled? So clearly Nvidia is important, but it's important because it's really one of the most important ways to get exposure to AI.
Now, Tom Lee is saying that Nvidia is a generational story, and it's very hard to argue with that definition. It's not something that we see every day. Now, on this channel, we've been covering Nvidia for the past 3 years. In fact, in December 2021, we put out a video telling you, hey, this company is absolutely insane. In a rough kind of calculation, that's about 400% profit since. Actually, we did it again many, many times. And even in December 2023, I put out a video saying, hey, guys, this stock is going to double again. In post-split terms, the stock price was $48 when we put out that video. It's currently at 120. So it's another 150% just from December of 2023 when we put out that video. So I told you at least twice, if not more, about Nvidia. So if you've been watching this channel for a long time, you're not surprised. And that might be a good time for you to subscribe. It's free and you get information like this. Now, the thing with Nvidia is that you don't need to be a neurosurgeon to understand that this thing is trading at a massive premium compared to its intrinsic value. Sure. But a lot of people missed out on this company back in the day when we were talking about this in 2021. And now they're hesitant to start investing in Nvidia because it's up 400% since. And it seems excessive. You have to understand something. It's the same thing like if you go to a casino and you lose some money and now you're saying, I have to win back my money. That money's gone. That money isn't yours anymore. There's nothing to win back. You have what you have and they have what they have. Whatever the price was in December of 2021 or December of 2023, it's irrelevant. You have to look at this company. You have to understand, hey, this company is always going to trade at a massive premium. It will always keep getting better on the business side, and the stock price will always be above the intrinsic value. Good companies tend to do that. And to this point, I want to show you this clip of Tom Lee where he says we are in the early innings of this cycle. Check it out.
And I think the AI story is, early innings, as many people talk about. It's transformational in terms of productivity, and there's a lot of use cases developing. So as much as it might feel like a one stock market, as you know, there's a lot of stocks up more than 20% year to date. And I actually think breadth is likely to increase. So for investors, there's a lot of opportunities in the second half.
Now, what Tom Lee is saying is go back in history and check it out. The internet got invented, according to all kind of consensus opinions, in 1994 with the release of Netscape, right? So NASDAQ did 110% in the following 2 years after the release of Netscape. ChatGPT is just as big as Netscape, if not arguably much, much bigger. Since ChatGPT came out in November of 2021, we are now up 15% on the NASDAQ. 15%. Now, based on what happened with the NASDAQ and Netscape, we're about 90% away from the top in this market. That's what Tom Lee is trying to tell you. If this is for real, if this isn't the dot-com crash, if this is actually a real revolution, we're nowhere near the top. And I have to tell you something. In 1999, there was a lot of trash, a lot of hype, mainly from the smaller companies. This time, we're talking about Microsoft, Google, Apple. All the big companies are playing this game. You don't hear about the pets.com. It's the big guys who are playing this. And on top of it, unlike 1999, we have massive revenues, massive profits, and an actual product that works. So I actually agree with Tom Lee. I don't think we're anywhere near 1999 territory. This is for real. This is just the beginning, but it's going to be a bumpy ride. A lot of stocks, including the market itself, will be volatile throughout the next few years. The smart thing is to do what we've been preaching for the past few years. Buy slow every single month. Don't try to time the market. Buy slow like a machine. Forget about it. Stay in as long as the companies you chose are fundamentally just as good. Simple as that. I'll see you in the next one. Peace.